Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies of Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. The topic for the session 43 is rebalancing the portfolios. Before going to discuss about rebalancing the portfolios, let us know which concept that we discussed in the previous class. We have discussed about rebalancing the portfolio introduction part in the previous class. The objective of this chapter is to provide an overview of portfolio management strategies, portfolio revision, and rebalancing, and apply the various measures for evaluating a portfolio. Once the student attends this particular session, he or she will be able to understand the concept of rebalancing the portfolios. How does the rebalancing work? Here, rebalancing of portfolio works primarily in safeguarding the investor from overexposure to undesired risk. Often rebalancing the portfolio keeps the risk in the check with investors' tolerance levels. The equity performance varies drastically with that of the debt instruments. As a result, this will have an impact on the percentage holding to meet the changing financial needs. The overall risk changes as well. Hence, rebalancing the portfolio to meet the new requirements is a must. There are three strategies, however, none of them will guarantee returns. It's important to pick the right approach for rebalancing. Periodic rebalancing. Decide a time and make sure to revisit investments. Target to revisit investments at least annually. Periodic rebalancing is good as it inculcates discipline and is less time consuming. However, one drawback is that the investor might miss out on an excellent market opportunity to rebalance the portfolio. Tolerance band rebalancing. Here, rebalancing to align with original asset allocation is done by the percentage deviation in the asset. Have a 5% threshold and keep revisiting to check for this deviation and rebalance accordingly. For instance, Ms. Dhruti has 30% in blue chips, 20% in mid caps, 10% in small cap, and 40% in bonds with a tolerance of plus or minus 5% for each asset class. As the holdings move outside the tolerance band, Ms. Dhruti will have to rebalance to reflect the initial composition. Allocating new funds. In this strategy, instead of selling the good performing assets and rebalancing the portfolio, the investor can infuse more money into the portfolio for rebalancing. In other words, to maintain the desired asset allocation. The investor can infuse capital into the required asset classes. Regular deposits can help in periodic rebalancing and inculcate financial discipline as well. Rebalancing by allocating new funds means that one is positive, hopeful that the excellent performing assets continue to outperform. Who should do it? That is the question. A day trader should check his investment daily. An investor shouldn't try to micromanage or check the investments daily. However, this doesn't mean investors should invest and forget about it. A regular check on how the investments are performing is essential. Investors investing in equities and debt like shares, ETFs, mutual funds, bonds and other debt securities should look at portfolio rebalancing every year, at least once. Investors investing in securities with fixed maturities like FDs, PPF, NPS or SSY shouldn't bother about rebalancing. The returns and tenure of investment for these are fixed, and investors need not worry about asset allocation here. Investors who have a financial advisor who manages their investments need not worry about rebalancing at all. When should you rebalance? That is the important question that we need to understand. One can choose the interval for their portfolio rebalancing from the available multiple alternatives. Rebalancing a lot might increase the rebalancing expense like trading costs, tax, etc. But not rebalancing at all might lead to severe losses. Investors ideally are suggested to rebalance their portfolio once in a year. They can make it a habit to rebalance the portfolio on the same day every year. Irrespective of the changes in the portfolio, rebalancing can be done yearly. There is another way to look at rebalancing. Investors can choose an ideal asset allocation and the deviation from which is accepted. Any time during their investment journey, if the asset allocation across the deviation, the investor can rebalance the portfolio. But the problem with this method is that if the market movements are higher than the deviation chosen, then the portfolio rebalancing will have to be done multiple times a year. This might increase the cost of rebalancing. Hence, it is ideal to monitor the portfolio annually or semi-annually and rebalance the portfolio only when the portfolio is 5 to 10% away from the target. This will help reduce excessive portfolio rebalancing and, in turn, the rebalancing expenses. Advantages of portfolio rebalancing. The advantages of portfolio rebalancing are numerous. For starters, asset allocation is perhaps the most important decision you will ever make as an investor. This view is shared by Vanguard, one of the world's largest asset managers. If asset allocation is so critical, we need a method for ensuring that the allocation we targeted is the one we end up with down the road. Without it, you will quickly lose track of your original investment decision and why you choose it in the first place. No successful value investor can get through life without a proven risk management strategy. Portfolio rebalancing offers just that and gives you a very clear framework by which to achieve it. Rebalancing also is not nearly as complicated as some are led to believe versus as Vanguard notes in its research, there is no optimal frequency or threshold when selecting a rebalancing strategy. In other words, investors have plenty of flexibility when it comes to rebalancing. This flexibility extends to frequency, asset allocation, and asset selection. Learn about other portfolio management concepts. It is very important. We have disadvantages of portfolio rebalancing also. Of course, no investment strategy is without its shortfalls. With respect to portfolio management, the disadvantages mostly center on opportunity cost, transaction cost, and even taxes. Investors who are rebalancing their portfolio have to conduct more trades to recapture their desired asset allocation. More trades mean more fees, including purchase and redemption costs. In addition to fees, portfolio rebalancing is a very active process, which means time and manpower cost associated with research and asset selection. At the same time, the need to rebalance may force some investors to leave profit on the table because they are proactively managing their asset allocation. In the stocks or bonds example above, an investor may feel that the need to rebalance even when stocks still have more runway to continue higher. So, in a sense, they are leaving earnings on the table. Investors who rebalance within taxable investment accounts or vehicles may also incur capital gains taxes when they sell a portion of their assets so they can allocate the funds elsewhere. Those huge stock gains you enjoyed in the previous illustration can carry a hefty tax payout unless sheltered in a tax-free account. In order to summarize this session, there has been pros and cons for rebalancing of portfolio. The pros: threshold-based rebalancing strategies keep your portfolio disciplined and closely tied to your original or target asset allocation. At the same time, the portfolio rebalancing has cons. The taxes and brokerage transaction costs of threshold rebalancing can add up quickly, especially with really upper tight thresholds of 20% or less. Dear students, let us understand this particular session or concept with the help of some of the multiple choice questions. First question: rebalancing of portfolio works primarily in dash the investor from overexposure to undesired risk. We have four options. Option A, valuing. Option B, communicating. Option C, safeguarding. Option D, spending. Any guess? The answer is option C, safeguarding. Option 2, dash strategy. Instead of selling the good performing assets and rebalancing the portfolio, the investor can infuse more money into the portfolio for rebalancing. We have four options. Option A, allocating old funds. Option B, allocating new funds. Option C, evaluation. Option D, resource allocation. The answer is, can anybody guess the answer for this? The answer is option B, allocating new funds. Similarly, investors investing in securities with fixed maturities like FDs, PPF, NPS or SSY shouldn't bother about dash. Option A, remuneration. Option B, balancing. Option C, rebalancing. Option D, calculating. Any guessing answer for this? The answer is option C, rebalancing. Similarly, we have one more question. Investors ideally are suggested to rebalance their portfolio dash. Option A, once a year. Option B, once in 3 years. Option C, once in 6 months. Option D, once in 2 years. Any guessing answer for this? The answer is option A, once a year. Similarly, we have another question. It is ideal to monitor the portfolio manually or semi-annually and rebalance the portfolio only when the portfolio is dash away from the target. We have four options. Option A, 20 to 30%. Option B, 15 to 20%. Option C, 5 to 10%. Option D, 10 to 20%. Any guessing answer? The answer is option C, that is 5 to 10%. Dear friends, you have so many books and references on this particular topic. I recommend all of you to go through the references that we listed in this slide, where you can understand in detail about rebalancing the portfolio. I wish you all the best and good luck all of you, and thank you for your patience listening. Thank you very much. Thank you.